Good afternoon. My name is Mike Rosenberg. I'm a strategy professor of IESE Business School. Welcome to the series we're running on the situation with coronavirus or with SARS-CoV-2 or COVID-19, whatever you want to call it. Good afternoon if you're here in Europe. Good morning if you're in the Americas, and good evening if you're in Asia. We try to time these broadcasts so that people can watch it from all over the world, because of course our alumni association has people all over the world. So welcome from wherever you're tuning in from. Today we've brought one of our finance professors. This is Javier Estrada onto the program. Javier is a professor of finance at the IESE Business School. He has been a professor of finance and of economics in different schools around the world. He did his doctoral work in the University of Illinois, even though he's originally from Argentina. Javier's research is on portfolio management, investing strategies, and risk. His stuff has been published not only on academic journals, but in places like the Wall Street Journal, the Financial Times, and places like that. He's also the advisor to mutual funds, helping them with their risk strategies. And in these times of risks and these crazy times of volatility, we don't know who else to turn to besides Javier Estrada. I know Javier best because he's also the academic director of our Global Executive MBA, where I'm one of the strategy professors. So we're always talking about things like that about the program. Javier, when we worked on the title, we decided to call this talk, investing in a volatile environment. You're a specialist on risk. How crazy is it? How volatile is it?
Well, good to be here, Mike, and hello to everybody, wherever you are in the world, whether you're confined or not. Very, very strange times. I have a few things to show you in a minute, but painful, volatile, and there's light at the end of the tunnel. But let me start with volatility, which is actually what gave this session the title. So what I did, just to give you a little bit of an idea and perspective of what we went through from mid-February on. So I took daily data on the S&P 500, and maybe I should say that I'm going to focus a little bit more on global markets and the US market, because I know my colleague Javier Santoma had a talk with you not very long ago, and he focused on the Spanish market and the European market. So I'm going to try to be a little bit more global and focus on the world market and on half of the global market, which is the US market. So first,
Javier, by the way, Santoma was here 3 weeks ago, and in these times, that seems to me like another century. We were in the studio at IESE, we weren't home yet. It just seemed like a completely different universe.
It is, and actually you can see that in the data too, because the worst, I mean, we would like to think that the worst is over. That remains to be seen, but as I'll show you in a couple of minutes, by mid-March, March 23rd or so, that's when things got really, really ugly, and then they got better from that point on. So yes, 3 weeks ago looks like a lifetime in these times. And just to give you an idea of that, so the first thing I did was to look at the very long-term perspective of daily data. I just wanted to look at this daily because, there's no point looking at this annually or even monthly, because all this is very, very recent. And so from the beginning of 1928 through the end of 2019, so that's almost 4 months ago, there's about 23,000 trading days. And the number that I want you to focus on is that one. That's volatility. That's what gives the talk the name. And that volatility.
So sorry, you said 1928.
1928 through
not
2019.
2008 or something. You went back 100 years.
Exactly. That's because I wanted to give you a perspective of how different these times are compared to what you consider normal. And, that includes a lot of periods in which things were not normal. And so if you look in that very long-term perspective at daily volatility, that's just over 1%. And if you're not familiar with volatility, or some of the listeners are not familiar with volatility, I have another number, which is basically you take the average daily fluctuation and ignore the sign. So it doesn't matter whether it's positive or negative, and you take the average of all those, that's 0.75%. So if you're familiar with volatility, remember 1.14%. If you're not that familiar with volatility, remember 0.75%. Now, that's long term, and that includes ugly periods. So first, I'd like to take you back to our previous crisis, what most people call the global financial crisis. And that basically goes from the peak, October 9, 2007, to the bottom, March 9 of 2009. You have 355 sessions, trading days, and look at the volatility number. That's twice the historical standard. So volatility was 114 very long term, but it's actually 2.4 in that period of about a year and a half. And if you're, instead of following volatility, you're following this average absolute number, then again, it's twice as big the average daily fluctuation during the last crisis compared to the very long-term average. Now, I remind you that the last crisis was actually pretty ugly too. If you look at what is called the drawdown, which is the drop from the peak to the bottom, that was 57%. So you lost more than half of your portfolio in basically a year and a half, 355 trading sessions. And compared to the previous crisis, which was the dot-com crash, the other one was actually a little bit longer in time, and the fall was not as steep. So, it was very, very long period in which markets were going down. But it actually went down by about a half. So what I want you to remember from these two things is basically long-term daily volatility, 114%. Last financial crisis, it was twice the daily volatility. Now let me show you this crisis here and look at the volatility number. 4 times the average historical day. And if you're following the average absolute number, 3.5%, again, 4 times what we would call the normal, what happened in a regular day. So if you're thinking, well, are these really volatile times? They were. It still remains the case that the most volatile times were back in the Great Depression. That volatility was as high as it ever got at that point in time, but these are very volatile times. Another number that I think it's interesting is that minus 34%. 33.9, that drop we're going to see in a couple of pictures in a few minutes. And the problem with that 33.9%, it's lower than in the last crisis, it's lower than in the dot-com crisis, but in a much shorter period of time. So I have there from February 19th, which was the peak of the market. We were all happy up until that point in time, and going all the way until last Friday. Last Friday, I mean 4 days ago. And that's 46 trading sessions. But in fact, the drop of 34% was between February 19 and March 23rd. So in basically 1 month, you lost over 1/3 of your portfolio, or at least the US market went down by 34%. So clearly very volatile times, a factor of 4 compared to daily volatility. And the other thing that I wanted to show you quickly is if you look at the 23,000+ trading days from 1928 on, if you look at the worst 10 days, 2 of those were in the last couple of months. So again, the worst remains Black
Javier,
Monday.
I have my glasses on, but I can't see it either on the screen or on this piece of paper. What was the worst day?
The worst day was, it remains Black Monday in October of 1987. The Dow Jones fell about 22%. The S&P 500 fell about 20.5%, which is the number that you got all the way to the left in the picture. And then the third number that you have in the picture, that minus 12%. Remember, that's 1 day. It's not 1 year or 1 month. It's just one day.
It's a bad day.
Was on March 16th of this year. And then if you move 3 bars to the right, you have a minus 9.5%, which is actually one of those 10 worst days in history. So out of the 10 worst days from 1928 on, 2 of them were in the last couple months. Now, on the flip side, because I don't want you to get depressed this early in the talk, we also had 2 of the best days. So if you actually look at the best days from 1928 on, you have a great day in 1933 when the market went up almost 17%, but then you have 2, the last 2, in fact, which were more than 9% in 1 day. And so at the same time, we had 2 of the worst 10 days ever and 2 of the best 10 days ever. So the answer to your question is that there's a good reason when we chose this title for the talk. We are living very, very volatile times, and they look a lot more volatile than they were during the global financial crisis.
Javier, let me just interrupt you for a minute because
Sure.
this talk is being broadcast live on our LinkedIn platform, on YouTube, on La Vanguardia. And the people who have been watching these before know that if you type in your questions in the comment bar, they will magically come to me on this device in my hand.
All
So we
right.
have people from our Alumni Association watching the chat. They're going to take questions and they're going to formulate those questions and give them to us here. So what's been going on in the markets? And by the way, I don't know if you're ready for this, but someone's asking about the bond markets. But you can choose to play there or not. But what's going on in the markets? Is it as bad as this might look?
uh, it all depends what you call bad. Everything is relative. Let me start with the S&P. And sometimes I always justify taking a special look at the U.S. market for a very simple reason. If you look at global equities, half of world global equities are the US market. That's why I always pay a little bit more attention. If you have a portfolio with a bunch of assets, but one of them is half of your portfolio, it's kind of obvious that you would pay a little bit more attention to that one.
S&P is the Standard & Poor's list of 500. You use that instead of some other index. Is that correct?
I have one thing to show you about the Dow a little bit later, but yes, mostly the S&P 500 is what most people call the market, except for some news channels that they still focus on the Dow. So this is the most basic and widely used representative of the US market, but I will also show you some data of the global market, global equity markets, which is measured with another index from Morgan Stanley, and I'll get to that in a minute. But being the US half of the global equities, what I'm going to show you for the S&P 500 and what I show you from the world market are very, very similar, which is not actually all that surprising. So the picture that you have there is basically the behavior of the US market as summarized by the S&P 500 between the beginning of the year and last Friday, so 4 days ago. And so that's the peak of the market. February 19th, everything was happy-go-lucky. We were all happy. Markets, we had a spectacular 2019. We were on a roll again on in 2020 up until February 19th. And then if you look at the picture, your eyes won't fool you. It was all downhill from there. So one interesting thing is that on March the 12th, that there's these definitions of bull market and bear market, which are not scientific at all, but people like to talk about bulls and bears. And so bull is a 20% increase from the previous bottom, and bear is a 20% decrease from the previous top. And so on March the 12th, the S&P 500 fell 9.5%, and actually that's the day when we enter into a bear market. Remember that the bull market has started in March 9 of 2009, and so from that point on until March the 12th of 2020, we never had a 20% change.
So 11 years of increasing stock market value.
The longest bull market in history, at least in US history.
And now President Trump says it's all because of him.
Of course, but we're not going to get into politics. We're going to stick to the numbers because politics is a completely different ball game. So that day on March the 12th, actually, that's kind of an anniversary because we entered the bear market for the first time in more than 11 years, but we enter with a bang, as you see there. Yes, 9.5% decrease, to the point that, if you compare February 19th to March the 12th, we didn't actually go a little bit below the 20% mark that would indicate a bear market. We went down almost 27%. So that's the beginning of the bear market, if you will. But it actually got worse after that. So after that, then all the way to March 23rd, markets kept going down, of course, with volatility going up and down, but they kept going down. And from that point on, the recovery begins. But if you go from top to bottom, we lost that 33.9%, call it 34% that I had shown you before. So that's a lot of pain to bear in a very, very short period of time. So this was very volatile, very short, and very painful. And when I'm saying very short, I'm just, I'm trying to be optimistic and think that the worst is in the past rather than in the future. But of course, nothing guarantees that markets will not go down and could actually go down lower to where they were on March 23rd. But between February 19th and March 23rd, we lost that 34%. If you look at, this is the MSCI ACWI, and that stands for Morgan Stanley Capital Indices, and ACWI is All Country World Index. So this is the most widely used benchmark for developed and emerging markets all put together. And as you see, the behavior here is very similar. The peak was actually a week before, on February the 12th. We enter bear market on exactly the same day, on March the 12th, with that 9.5 decrease. We went down 26.3% from the top. Markets kept going down through March 23rd, just like the S&P pretty much. And from top to bottom, it was almost exactly the same 34% decrease between February the 12th and March 23rd. So,
Javier, you might be
yes.
coming to this in a minute, but just before you do that, a couple of people are asking, is this just the correction of this very, very long bull market and it had to correct sooner or later, or do you think this is due to COVID-19?
There's one thing that I like about that question is I like to watch financial news on TVs, and I always kind of laugh when people try to explain the daily movements in the market. You can't do that. It's very difficult to attribute the minus 2% that you may have today or tomorrow, or the plus 3% today and tomorrow, to this reason, this reason, this reason, and this reason. But with that said, at some point in time, the market had to correct after 11 years of pretty much going up. There had to be a correction, but I think that it is clear that this correction has a very clear cause, which is everything that we're going through these days. Call it COVID-19, call it the pandemic. So at some point in time, markets had to react to this. Economies have come down to a full stop or mostly to a full stop in most countries, and so the markets have to reflect that. Remember that markets tend to move ahead of the economy. So when you see bad news, when you hear bad news, you start thinking, what is going to be the impact of this on stocks? And even if the bad news haven't materialized yet, you typically reflected before, ahead of time, in stock prices. So it's scientifically, it's very difficult to say whether this is because this specific reason, but certainly, it would be common sense to say that this is the reaction to the news of COVID-19, and therefore all the implications of COVID-19. Companies doing less business, economies growing less, not growing, actually stagnating and decreasing in many cases. It's a reflection of all those perspectives.
Yeah, we've had some economists on this series, and
right.
The contraction of GDP is serious, and
It's
I think
serious.
everybody knows people who are out of work. My wife's a chiropractor; her office has been shut. So I mean, it's very, very widespread. The
And
impact.
of course, from where we sit, from where you and I sit, we see it actually very clearly too. How companies are actually, cutting their business and trying to move some of their business online, and we see it all over the place. I mean, the economies have come to stand still. I would say, with one difference, though, compared to other crises that we've had before, and is there's millions of people around the world and in each country without jobs. And I think that one of the differences is that a lot of the people that don't have a job right now is because the place where they used to work has come to stop. But at some point in time, that place will reopen. That restaurant, that gym, that movie theater, all those things will reopen, and these people will be rehired, or they would go back to work. So a lot of people are calling this like a V-type recession, in which you go down very abruptly, but you also go up fairly quickly. We can hope that, and markets always try to reflect that. You might have seen, and I'll show you a couple more numbers a little bit later, but you might have seen that this is actually what's been happening. In March 23rd, we had that bottom, and things got substantially better in the markets from that point on, meaning that people are incorporating the expectations that things are beginning to pick up. You're
Is
from
it
the
is it
US.
is it is
Yeah.
it people at the heart of this thing? There's two or three questions about algorithms and electronic trading. Are there really humans making these decisions, or is it all really smart machines?
I think it would be very, very hard to blame this market drop on algorithms. Of course, they play a role, and more and more business is actually being, in a way, automated. But there are strategies that that there's this so-called smart beta type of investing, in which you basically have an algorithm. It's not the algorithm that people typically have in mind when they think of algorithm trading, but I don't think that you can blame high frequency traders. I think that this is very fundamental, what's been going on. You can't have economies coming to stand still and the market not reflecting that. So I think that this is kind of common sense, that what the market is reflecting is a deterioration in fundamentals. And as soon as the fundamentals actually begin to look better, markets begin to reflect that, probably even before things get better. The expectations that things will get better sometimes helps enough.
Okay.
But just to finish then, that your question whether things were bad enough, well, that's the first quarter. If you go through the end of March, that was actually for the S&P 500 that we had looked at before, that was the worst quarter since 2008. But if you look at the Dow Jones, it was the worst quarter since 1987. So that's a very long time without a quarter this bad. So things clearly were serious, were bad, and all of that happened in a very short period of time. So if you look at the global markets, that's again the MSCI ACWI, which is the bar on the left, all the way to the left. So that market actually lost 22% or almost 22% for the first quarter. So global equities, obviously, if you were invested in equity, the first quarter didn't make you very happy. I would go as far as saying that.
Javier, we have a few questions from different people asking more or less the same thing, which is this pain been widespread, or has there been some exceptions where some sectors are okay and other sections are terrible? I mean, I
Yeah.
guess Zoom stock must have gone up because all of us are on Zoom all the time.
Yeah. I'm the last guy that would actually sort of invite people to get picky with stocks and try to pick stocks, particularly in very volatile times. You mentioned Zoom. There's an interesting story about Zoom. There is this thing called the ticker, which is a bunch of letters, usually 2, 3, or 4, that identify stock. And Zoom ticker is not Zoom, but there is another company that has the ticker called Zoom, and people were buying into that company thinking that they were buying the Zoom that you're talking about. And so the SEC had to come out and say, hey, you guys are not buying not the right thing, but you're probably not buying what you think you're buying. And so, when people buy, sometimes, they buy the next big thing, or the one that was the big thing yesterday. I think that this is not a market to get really picky. Back to your question,
So there's no place to hide from the damage, in other words.
There is very little place to hide from the damage. Of course, when you can always talk about layers of diversification, and sector diversification helps, geographical country diversification always helps, but people sometimes forget that the primary way of diversifying is across asset classes. So even in this same picture that we have there, if you look at bonds, the 3 bars in the middle are bonds. That's global bonds. The next one, the one in green, is the US, and then the next one is European bonds. 2 of those failed. One of the other one went up, but at least they didn't go down 20%. Well, that's diversification. If you have an asset that goes down 25% and the other that goes only 2%, well, that's diversification too. You cannot expect that things always would go up when something else goes down. But as you see, gold actually did fairly well, 5% for the quarter, but it's a 6th straight quarter in which gold goes up. So as usual, when things get shaky, gold seems to be the at least one of the places where people go for shelter. But I wouldn't discard in all of this the role of fixed income. I think that fixed income play the role that it's supposed to play. That even if it didn't go up as much as you would have wanted, at least it didn't go down as much as equities actually did. So fixed income, gold, they behaved as a counterbalance to how badly equities performed over the first quarter. But you're right. You said there's no place to hide. I just have here. Just take a look. I'm not asking you to see the numbers. Just look at the colors.
I can't see the numbers on my big iMac, so I guess
don't want you to
people
see
on
the
their
numbers.
phone
Can you
can't
see
see anything.
Can you see the color red? That's the only
Yes.
thing I want you to see. That's a whole bunch of markets, all of which are in red. The only thing that is not in red there, which is in green, is the volatility index, which is actually goes typically in opposite direction to the US market. But as you see, all those lines that you see are countries, all those red numbers are countries going down at the same time. So, even if you were very broadly diversified in equities worldwide, there was no place to hide. That was March the 12th, and this is March 24th. Again, you may not see the numbers, but look at the colors. No, everything is green on that
These
day.
are all different stock markets all around the world, and they're all red.
That's exactly right. There's red on the one day and there's green on the one day. And so that's correlated. There's this aphorism in Wall Street saying that when markets go down, the only thing that goes up is correlation. And that's exactly what you're seeing in that picture. That, market, they all went down at the same time. They all went up at the same time. So, you were saying there's no place to hide. And within equities, probably not. Of course, there were some companies that did well. It's very difficult to find them ante. You can always look back and ask the question, which companies did well over the last 3 months. But, if you're thinking ahead 3 months or 1 year, then of course it's a lot more difficult to say which ones are going to be doing well. So very little place to hide in equities, a lot more place to hide if you were diversified into fixed income and if you were diversified into gold too.
Fixed income is bonds, of course. Javier, what a couple of people are asking, and I think you have something prepared on this, which is, you said March 23rd was kind of the low point in recent times. Then there's a rebound. How big was that rebound? And do you think the worst is past and it's going to be uphill from now on? Now, one of the people say that markets in the U.S. seem to recover already. Maybe that's too soon. What's your view on how big has been the rebound and where are we going?
Right. Two very different questions. The first one is very easy because you can actually quantify that. The second one, it's a speculation because I can give you my view what's going to happen from here.
You know more, but I mean, you published 2 books on finance. One as the title. Everything you wanted to know about finance, but we're afraid to ask.
Right.
So if you can't speculate, who can?
And forecasting was not one of those issues, by the way. But anyways, so yeah, in the same, within the same quarter in which we had to endure a lot of pain, there were some really good days, some really good weeks. That's the Easter week, and that title that you see there. And the Easter week had only 4 trading days, but during those 4 trading days, the S&P 500, the US market, call it, went up 12% in 4 days. The Dow almost 13%, and the world market over 10%. So there were some highlights, there were some good days and good weeks, but there's a better way to actually look at that, which is those 2 green bars. So from the bottom of March 23rd, which was the same day, the bottom for the US market and the world market, up until last Friday, the US market went up almost 27%, and the world market went up about 23%. So, we came up quite a bit from the lows of March 23rd, but the other 2 bars are kind of the bad side of the story, which is where we are from the beginning of the year up until last Friday. And so even with that recovery of 27% in the US market, 23% in global equity markets, we're still 12% down for the year in the US, and 16% down for the year, a little bit more than that, for the global market. So yes, there were some highlights there. Yes, there were some periods. Yes, it was a spectacular rebound, but we're still quite a bit below from where we were in the happy days, the last happy days, call it, of 2019.
And so you think that is going to be continue, or you don't want to make any projections?
Um,
Let me just read you one of the questions, which is
yes.
about Warren Buffett saying that we're in a bubble anyway, and it has to deflate. And yes, probably triggered by the COVID crisis. But is this just the deflation of the bubble anyway? In which case, we'll see it bump along, or is it going to be as the world opens up, we'll see it get back to these good
Uh,
times, as you call them?
Well, that's what I would hope. Actually, I was looking at markets before coming here, and markets are having a good day today. Good news are beginning to pile up a little bit. Georgia opened business, sort of open for business, if you will, in the last few days. More states in the U.S. are beginning to open. Germany is beginning to open business. People were out, out of confinement, at least in a restricted way, in Austria for a couple of weeks now. There are some good news there, but economies are not like a switch. You kind of go from off to on that easily. So it's gonna take time, and a lot of places will not be able to open yet for some time. But remember, once again, markets are forward-looking. So whatever you think it may happen, some good things that may happen in the foreseeable future, in the near future, the markets are going to reflect today. I would love to think that the worst is over, and that everything that's bad to price in markets has already been priced. But of course, nobody can guarantee that. I think that it cannot get much worse than what we already have. I mean, most economies came to almost a complete standstill. What could be worse than that? That we have another, going back to the worst days of this pandemic. But other than that, probably markets have priced the worst, and now what we have is actually the better times ahead. One thing that I found interesting is Morningstar, usually by the end of every year, they interview some companies in Wall Street, and they make these projections about expected returns. And so they usually had one, by the end of every year. They had one by the end of 2019. Of course, markets were expensive and the forecasts were not very rosy. But the interesting thing about that is that, those forecasts that were updated after this COVID crisis, to give it a name, they are now much better than what they were at the end of 2019. The reason being that markets are cheaper now than they were at the beginning of 2019. So it's interesting because I don't believe in forecasts, particularly short-term forecasts. I think it's the short term is completely unforecastable. But if you look medium to long term, there are reliable ways to make forecasts. There are companies that make fairly reliable forecasts, and all those companies have revised the expectations upwards compared to the end of 2019. And that's mostly motivated in the fact that markets are cheaper now than they were at the beginning of 2019.
So if you think ahead in the long term, not asking you to make a forecast, just using common sense, how long before we see another bull market?
That's an interesting question, because you're seeing it right in front of your eyes. Remember that the definition of bulls and bears is plus 20 and minus 20 from the bottom and from the
I
top.
learned the definition about 10 minutes ago. So
That's right. But so there's nothing. I mean, like I think I said before, that there's nothing scientific about bulls and bears markets and plus or minus 20%. But people like that terminology. So right there in front of your eyes, from the lows of March the 23rd through the end of last week, we have 27% up. That's over 20%, and that qualifies as a bull market for the US, and over 23% for the global equities. So that qualifies as a bull market for global equities. But the interesting part about bulls and bears, I think it's in the Dow. It's an index that, again, I don't usually pay too much attention to, except for this one thing that I'm going to show you, which is, the behavior was very similar to the rest of the US market. We enter the bear market on March 11th, and then the market came going down. The Dow kept going down through March 23rd. When it was all over, it had fallen 37%. All right, so that's more or less what I show you for the S&P 500 and for the world market. But here comes the interesting thing. From the bottom of March 23rd, look at that, one trading session, two trading sessions, three trading sessions, and then you have a plus 21.3%, which classifies as a bull market. It's probably, I haven't completely checked this, but it's probably the fastest return, the fastest flip from a bear market to a bull market ever. I can't recall from the top of my head any other. In 3 days, the market went up more than 20% and we were back to a bull market. So the US as measured by the S&P 500, as measured by the Dow Jones, and global equities as measured by the MSCI ACWI, all of them are back in a bull market, whatever that means. Again, we're still down for the year, but we're back in a bull market. So the Dow is still almost 17% down for the year, but the rebound from the bottom of March 23rd through last Friday was 28%. So, if you had lost a lot of money on the way down, at least a 28% recovery makes you a little bit happy. These are the things that if you're an investor, they make you feel a little bit better after a whole lot of pain.
So we have a whole bunch of questions. I don't know if I remember seeing so many questions. A lot of them are on specific categories of stock, and feel free to say, I don't look that detailed, but let me just ask you some of these questions anyway, just at least so we can get them off the list, and then I'll go back to another question for you.
Okay.
Now, some companies are paying dividends. Are they going to be able to continue to pay dividends in this time, or will they stop paying dividends? And some people are asking, should they, what's the relationship between kind of solid, what we used to call blue chip companies, which pay dividends all the time, and more speculative stocks on, new digital technologies, startups, et cetera, et cetera.
Right. I think that you're going to see substantially lower dividends in the foreseeable future. Some companies that are getting, call them bailouts or however you want to call that, public money, so to speak, they're going to have a very hard time buying back shares for sure, or paying dividends. And if I remember correctly, either yesterday or the day before, there was an article in the Wall Street Journal saying, shareholders of Boeing are not going to get a dividend for many, many years. So I think that, companies are very much cash constrained, and I think that dividends are going to come down substantially, certainly in the short term. A little bit, further ahead next year, things may actually change quite a bit, but in the short term, I think that everybody should be prepared for no more buybacks and dividends substantially lower than they were before. As for differences across either sectors of styles, one of the curious things about what's been happening, and this is not new, but it goes a few years back, is that in finance, we have some regularities, some patterns that get repeated over time and in many different places. And one of those is that value outperforms growth, meaning cheap companies, as measured by some multiples, by some fundamentals, tend to outperform growth companies. But over the last few years, that was the other way around. Growth companies tend to have outperformed value-oriented companies. On the flip side, small companies, meaning small capitalization, typically small companies compared to the very large companies from Microsoft to Apple to Google or Alphabet, I should say. So the regularities that small caps typically outperform large caps. But in the last few years, and particularly last year, that was not the case. Actually, the flip side was the case. So we are in a market in the last 3, 4, 5 years in which two typical regularities that people tend to rely on, value outperforming growth and small caps outperforming large caps, the opposite has happened in both cases. And of course, there's two ways of reading this. One way of reading this is, the typical one, the world has changed. And because the world has changed, forget about those regularities. In a new world, these are the things that are going to happen. But of course, there's another way of interpreting that, and that is, one of the strongest forces in markets is what we call mean reversion. things tend to go back to the normal. And if that happens to be the case, then value and small caps are very cheap compared to growth and large caps. So you would say, if you're one of those contrarians, then you would say, this is an ideal time to buy into what has been left behind in this long rally that we've had over the last 3, 4, 5 years or so. But of course, that is as picky as I typically get. I wouldn't be the guy to advise anyone to pick sectors, or even less so to pick companies. I don't think that, particularly in very volatile markets, that's the last thing that you may want to do.
Okay, well, there's a couple of questions coming back to your comments on gold, and someone's actually adding Bitcoin. Is this the time to buy gold or Bitcoins?
Those two things are pretty different.
Same
Gold
question
has
from one of our viewers today.
Right. Yeah. See, gold has been a shelter for centuries. And although, Warren Buffett typically is kind of negative about gold because it's difficult to assess the intrinsic value of gold. Basically, the value of gold is what other people are willing to pay for it. And it has no industrial uses mostly. And so gold is kind of tricky, except for that one thing, and that is that when people get scared, they go for shelter in gold. And not for the last year or the last decade, but for centuries, that actually has been the case. Now, there's a problem with gold. And the problem with gold is that if you look at the very, very long term, gold has beaten dollar inflation by 1.5%. So it hasn't been a spectacular investment. That's the reason why when I talk about gold, I always think about insurance. When you have gold in your portfolio, basically what you're buying is the following. If markets do well, you're buying into an asset that is not going to be doing very well. But when markets do badly, gold will actually help you sustain your portfolio. And as a matter of fact, I don't have the graphs here, but I usually show two graphs of the last two crises, the global financial crisis and the dot-com crash, that having gold in your portfolio helped you a lot in those bad times. But of course, in the long term, it's going to be a drag on the return of your portfolio. So if you're going to have gold, is because you never, for the same reason you have insurance for your car. Typically, if you're a safe driver, you're paying insurance premiums, but you don't get any return on that insurance if you don't have an accident. And so you're basically losing all the time to the insurance company. But the reason you buy it is because you say, well, I never know when I'm going to have an accident, and therefore I have it just in case. Of course, the ideal policy would be, I'm going to buy insurance the day before having an accident. I don't want to be paying insurance premiums before that. But of course, you never know when you're going to have an accident. Well, gold is exactly the same thing. You can say, I'm going to have gold in my portfolio. Ideally, I would like to have it when markets go down, but you never know when that's going to happen. So having gold in your portfolio is that kind of insurance policy, if you will. You're going to have a drag on returns in the long term, but it may pay off when things get ugly. Bitcoin, I would put it in a completely different category. I think that I never put in the same sentence Bitcoin and investment. I think Bitcoin is pure speculation. And if you're the kind of speculator, if you like to, get in and out and get into the action and out of the action and make the quick buck, Bitcoin and many other currencies or virtual currencies are good for that. But if you call yourself an investor, I don't think you would buy Bitcoin.
And so there's a couple of questions on oil. Would you put oil into the investment category or the speculation category these days? Because it's the price of oil I checked yesterday was at $20, which was
it's been going down dramatically. And as a matter of fact, I'm sure you read in the papers that there were some negative prices for oil.
Prices, people giving oil away. Take 1,000 barrels, please.
Sure, but that has to be put in the proper context. It's not the actual oil price went down. The futures went down, mostly because when you buy a futures, what you're buying is basically a promise that someone is going to deliver oil to you. Now, of course, you don't buy those futures because you intend to receive the oil. You buy those futures because you buy it today and you expect it to sell it at a higher price tomorrow or next week or next month. The problem was that the futures contract was about to expire. And if you have that futures contract when it expires, then you have to actually take possession of that oil. And if you're a regular investor, of course, you have no way to take possession of that. Now, at the same time that that was happening, most of the deposits, well, most of the places where you can store the oil were pretty full. And so if you have that futures contract on the day that it expires and you have no way to store that oil, well, the thing that you have to do is sell that. And if nobody wants to buy it, you're willing to pay someone to actually take it out of your hands because you have no way to store the oil. But that's basically what
Okay,
happens. But
let's not spend more time on that. We have about 5 minutes left. Javier, there's a bunch of
okay,
questions about what to do. You know,
what
what should an investor do, you know, when staring at this crazy volatility, and exactly what should they do and what should they not do? I think that's kind of the most important thing to kind of close this session with.
Right. And, I could have had a very long list. I made a short list, but, sometimes people get scared, and that's absolutely natural. If you lose 10%, 15%, 20% of a portfolio, particularly if that happens in a very short period of time, as it happened this time, and for reasons that you think are very clear. We know why, more or less, why stocks have been going down and why these markets have been so gloomy. I don't think that if you have the right portfolio to begin with, if you know your strategy, if you know where you're going, I don't think that this is a reason to sell. If you know where you're going with your portfolio, and if you have the right asset allocation, the right proportion between stocks and bonds, then you should be able to navigate through these stormy waters. So first thing that I would remind people is ask whether your goal has changed. Has the reason why you have your portfolio changed, and has the period of time in which you intend to hold your portfolio change? If those two things didn't change, if you still want to send your kids to college in 15 years, or if you still want to move to a nicer house in 5 years, maybe there's no reason to sell. Now, if you wanted to buy another car before the summer, well, then it's a completely different thing. But selling because prices have gone down, selling because other people are selling, that's going with the crowd usually ends up being expensive. Being contrarian, which is extremely difficult, it's easy to say but not so easy to implement. Being a contrarian is a much better strategy, but of course is very painful and difficult to implement. So don't
Javier, we've got
sell.
about 2 more minutes, so go. I think you've got 3 more do's and don'ts, or 6 more.
Okay. Yep. Don't do the opposite. Don't say, well, prices have gone down 20% or so, and therefore, I'm going to buy because everything is cheap. Well, you don't know whether everything is cheap. You have to think when you need the money, because if something has gone down 20%, nothing actually says that it cannot go down another 10 or 20%. And if you need the money in the next 2 weeks or 3 weeks or 2 months, then buying because it's cheap is not a good strategy. A lot of people love to take advantage. Oh, markets are going down, up and down and up and down. Maybe I can get in here and can get in there. I think that this is a good time to reassess your asset allocation. Just look at the proportions of stocks and bonds. If you are feeling too much pain, or you feel too adventurous, that means that probably you don't have the right asset allocation. If you have the right asset allocation, if you have the right portfolio for you, you should be okay with what's going on. I'm not saying happy. I'm saying okay with what's going on. It's part of the investment process that markets at some point in time are going to go down. Don't be blinded by these great stories. You always read about someone that's making a killing in the market. There's always those stories. Just look at the big picture of that. The name Bill Ackman has been quite a bit on the press because he made $2.6 billion out of some hedges that he had. But this is the same guy very good investor, very well known, great reputation, but he also lost $1 billion with Herbalife and another $4 billion with Valiant Pharmaceuticals. So you win and you lose. Don't be blinded by spectacular gain. Just look at the longer term track record. And I think that the best advice is that one. Don't pay too much attention to daily fluctuations. That's basically noise. And in finance, we always make a distinction between the signal, something that is useful for making a buy or sell decision, and the noise, which is something that actually clouds the signal, makes it more difficult to understand. So the last piece of advice that I would have is, if you do have trading apps on your cell, take them out. Because if you do, then what typically you're going to do is what everybody else is doing. And that is actually not where you want to go. You're going to be fearful when everybody's fearful, and you're going to be greedy when everybody's greedy, and you want to be, clicking your phone all the time. I think that is a really bad thing to do, particularly in the volatile markets that we have in these days.
So Javier, the new normal, are we going to get to a new normal, or is this just part of normal?
Maybe I guess I'm a very optimistic guy, and I would like to think that the new normal is not going to be too different from the normal. I hope that it's not too different, but time will tell.
Javier Estrada, thanks so much for coming on the series. I think it's been a fantastic session. Remember that this session is available for viewing later on the LinkedIn platform, on the IESE Business School YouTube channel, and also on La Vanguardia. And tomorrow we have something kind of special. Jordi Canals, our former dean, will be talking. He's going to be at 4:30 p.m. Europe, 10:30 a.m. in New York, and 10:30 p.m. in Shanghai. He's going to be talking about the role of boards and governance in these special times. And he'll be with our communications director, Greg Berkey, to do that session. So it's going to be an important session, and I urge you all to watch it. That's all for us this afternoon. Thank you for watching, and please keep safe.
Thank you, Mike, and thank you everybody out there. Goodbye.